The IRS accepted 13,153 offer in compromise applications in fiscal year 2022, settling approximately $164 million in tax debt. The average accepted offer settled a $25,000 tax liability for roughly $12,500, about 50 cents on the dollar. You have heard the radio advertisements promising to settle tax debt for pennies. Some of those cases are real, many are not. The IRS has a specific formula for calculating what it believes you can pay, called reasonable collection potential, and it will not accept an offer below that figure regardless of how much you owe. Here is how the calculation actually works. An offer in compromise is a formal agreement under IRC Section 7122 in which the IRS accepts a payment less than the full assessed tax liability in final settlement of the debt. There are 3 grounds on which an OIC can be submitted. Doubt as to collectability, the most common basis. You genuinely cannot pay the full debt from current and future income and assets. Doubt as to liability, you dispute that the tax assessed is actually owed. Effective tax administration. The full amount is technically collectible, but collection would create an economic hardship or would be inequitable due to exceptional circumstances. Most small business owners qualify, if at all, under doubt as to collectability. Before submitting an offer, you must be in filing compliance. All required tax returns must be filed, even if they show balances due. You must also be in payment compliance. Current year estimated tax payments must be current. If you owe from 2022 and 2023 returns but have not filed your 2024 return, the IRS will return your OIC application without review. Addressing compliance before submitting is not optional. Additionally, you must submit Form 656 with a $205 application fee and an initial payment, either 20% of a lump sum offer or the first month's payment of a periodic payment offer. Reasonable collection potential, RCP, is the IRS's minimum acceptable offer amount. It represents what the IRS believes it can collect from you given your income, expenses, and assets. The formula, RCP, equals your net realizable equity and assets plus the present value of your future disposable income over a defined period. Net realizable equity and assets is the quick sale value of your assets, approximately 80% of fair market value for most property, minus any liabilities secured against those assets. Future disposable income is your monthly income minus your monthly allowable expenses multiplied by a payment period. The allowable expense standards are not your actual expenses. They are the IRS's national and local standards, which cap what the IRS will accept as reasonable living costs regardless of what you actually pay. National standards cover food, clothing, housekeeping, personal care, and out-of-pocket health expenses by household size. Local standards cover housing and transportation by county. If your actual rent exceeds the local standard for your county, the IRS uses the standard, not your actual rent, to calculate your disposable income, which makes your RCP appear higher, making it harder to qualify. This is where most OIC rejections originate. The income projection period depends on your offer structure. A lump sum offer, paid in 5 or fewer installments within 5 months of acceptance, uses 12 months of future disposable income in the RCP calculation. A deferred payment offer, paid in monthly installments over 6 to 24 months, uses 24 months of future income. If your monthly disposable income after allowable expenses is $400 and you make a lump sum offer, the income component of your RCP is $4,800. Add any net realizable equity and assets, and that is the minimum the IRS will accept. An offer below that figure will be rejected. Common reasons OIC applications are rejected: insufficient offer amount. The IRS calculated a higher RCP than the offer submitted. Undisclosed assets. The IRS discovered assets that were not included in the Form 4033, a collection information statement submitted with the application. Non-compliance, filed returns or estimated payments that were not current at submission. Recent income spike. The OIC specialist projected higher future income than the historical average submitted. And in some cases, the IRS simply believes it can collect more through standard enforcement, liens, levies, and garnishment than the offer amount. Addressing each of these in the application package increases acceptance probability. The IRS OIC pre-qualifier tool on irs.gov allows you to input your income, expenses, and asset values and receive a preliminary assessment of whether you may qualify. This tool uses the same standards as the IRS evaluation. If the tool indicates you do not qualify, submitting a formal application is likely to result in rejection and the loss of the $205 fee, though the fee is waived for applicants at or below 250% of the federal poverty level. The pre-qualifier is not binding, but it is a useful first screen before investing time in a full application package. If your OIC is rejected, you have 30 days to appeal the rejection to the IRS. The appeals officer reviews the case independently and may accept an offer the examiner rejected, particularly if there are equity or hardship factors that were not fully weighed at the examination level. If appeals also rejects the offer, your alternatives include an installment agreement, monthly payments over up to 72 months, or currently not collectible status, which suspends IRS collection activity when the IRS determines you have no current ability to pay. Neither resolves the debt, but both stop immediate enforcement while your financial situation is evaluated. An offer in compromise is a legitimate resolution tool, not a miracle. It works when the IRS's own calculation, reasonable collection potential, produces a figure significantly below the full tax owed, and when you submit a complete, compliant application with an offer at or above that figure. The advertisements promising to settle any debt for pennies are misleading. The actual acceptance rate in recent years is roughly 40% of submitted applications. Know the formula, use the pre-qualifier, and if you proceed, do it with professional assistance. If you want to understand the full range of IRS collection tools, our video on tax liens and levies, what the IRS can legally take from you, covers the exact rules. An offer in compromise is one way out, but the IRS has tools to pursue what it is owed. Tax liens and levies, what the IRS can legally take from you and what it can't, shows the full range of collection power. It is on this channel.